Hey everyone, ready for a deep dive into something that could really shake things up? We're talking about the UK's new wealth tax, and honestly, it's something everyone should have on their radar.
Yeah, it's a pretty big deal.
Yeah.
We're not just talking about what you earn anymore. This is about what you own.
Exactly. It's a whole new ball game. And to help us break it all down, we've had this fantastic article from MANCO
Yeah.
accountants.
So they really know their stuff when it comes to UK tax.
For sure.
Yeah.
So they've laid out all the need to know info about this wealth tax. And honestly, whether you're already rolling in it or just starting to build your wealth, there's something in here for everyone.
Absolutely.
Yeah.
So let's get right to it. What exactly is this new wealth tax, and why should we care?
Yeah, let's start with the basics.
Okay, so basically it's an annual tax, like
Yeah.
a recurring bill.
Sure.
But instead of being based on your income, it's based on your net worth.
Net worth meaning?
Everything you own minus any debts.
Yeah.
So property investments, savings, all that good stuff.
Okay, got it. So if your assets minus your debts come out to a certain amount,
Then bam, you're hit with this wealth tax.
and that magic number is
10 million pounds.
10 million. So, not exactly chump change.
Nope, not at all. Most people won't even come close to that threshold.
True. But the article mentions something interesting about public support for this threshold.
Oh, yeah, that's right. They did a YouGov survey and found that 78% of people actually approve of that 10 million starting point.
Wow, that's pretty high.
It is. But here's the thing. When they asked about a lower threshold, that support dropped like a rock.
Interesting. Makes you wonder if this 10 million is just the first step.
Right, like maybe it'll go lower in the future.
Especially with the government looking for ways to, address wealth inequality and fund all those public services.
Exactly. This wealth tax could be a way to kind of redistribute things down the line.
Something to keep an eye on for sure. So even if you're not swimming in millions just yet, this is definitely something to pay attention to.
For sure. But okay, let's say you are in that wealth bracket. How does this tax actually work?
Yeah, let's get into the nitty-gritty.
All right, so it's a tiered system. Think of it like a staircase. You hit that first step at 10 million pounds and pay 1% on every pound above that.
Okay.
But then there's another step at 20 million pounds. And that's where the rate jumps to 2% on everything above that second threshold.
Got it. So the more you have, the steeper those stairs get.
Exactly. The article uses the example of someone with 25 million pounds.
Oh, yeah, I saw that.
Their annual tax bill, 300,000 pounds.
Ouch. That's a hefty chunk of change.
Yeah, no kidding. And there's another little detail that can really trip people up.
What's that?
The tax is calculated individually, not per household.
Oh, so that could get tricky.
For sure. Especially for couples who have a lot of assets. Maybe they each have 8 million individually, no problem. But then they've got a jointly owned property worth 5 million pounds.
And suddenly they're over that threshold.
Exactly. It's a real gotcha moment.
So we've got the threshold, we've got the rates, but what exactly counts as wealth in the eyes of this tax?
Good question. The article breaks it down into 4 main buckets: real property financial instruments, business assets, and
Man, don't leave us hanging.
luxury items.
Luxury items. Now that sounds interesting.
Oh, yeah. We're talking high-end art, rare collectibles, vintage cars, all that good stuff.
So basically, if you've got a treasure trove tucked away, get ready for a visit from the taxman.
Pretty much.
All right, well, let's unpack all of this, starting with real property. I mean, everyone loves talking about property, right?
Well, your main home actually gets a bit of a break. A 20% exemption up to 2 million pounds.
Oh, okay, so some relief there.
But that exemption doesn't apply to second homes, rental properties, or commercial real estate.
Ah, so if you've got that vacation villa in Tuscany or a whole bunch of rental properties, those will definitely count.
Oh, yeah, they're going to factor into that equation for sure.
Okay, what about financial instruments? Stocks, bonds, all that jazz.
Those are valued based on their prices at the end of the fiscal year.
So even if the market's down, you're still taxed on that end of year value.
Yep, that's right. No hiding from the taxman if your portfolio is having a bad year.
All right, so no escaping that. What about business assets? I'm guessing this is where things get interesting for entrepreneurs and company owners.
Absolutely.
Mhm.
If your company is valued under 10 million pounds, you get a 50% deduction on those assets.
Oh, interesting. So that's to protect smaller businesses and encourage people to keep starting companies.
Exactly.
But I can see how that could create some loopholes, right?
Oh, for sure. The article even mentions that critics are worried about companies artificially fragmenting themselves
To stay under that 10 million pound mark?
to avoid that full tax burden.
It seems like there's always a bit of a game going on between taxpayers and the tax man.
Always.
Okay, so we've got property, we've got financial instruments, we've got business assets, and of course we can't forget about those luxury items.
Right. Like we said, high-end art, rare collectibles, vintage cars, jewelry. anything that's considered a luxury item and valued over 100,000 pounds individually.
Wow. So they're going item by item through those luxury collections.
It's a lot of work for everyone involved. But that's how they're doing it. They're using the open market principle to try to figure out a fair market value.
Okay, so they're really digging deep into those collections.
They are. But there's a 10% aggregate exemption. So your first few prized possessions are safe.
Well, that's something, at least. So we've covered what this new wealth tax, IS, who it applies to, and what kind of assets are included. But I'm guessing most of our listeners are still wondering, why should I care if I'm not even close to that 10 million threshold?
Yeah, that's the big question, isn't it? And it all comes down to what the article calls the cash flow challenge.
The cash flow challenge. Okay, that sounds a little ominous.
Well, it's where things get interesting for everyone, even those far below that top wealth bracket.
All right, I'm intrigued. Let's dive into that after the break. Okay, so this cash flow challenge, lay it on us.
All right, so picture this. You built up a nice little nest egg, right?
Yeah,
But most of it's tied up in things that aren't exactly easy to turn into cash.
like a
Property, for example. Or maybe you've got a stake in a business.
Yeah.
Or even like a valuable art collection.
Right, those aren't things you can just sell off on a whim.
Exactly. And that's where this wealth tax can really throw a wrench in things.
How so?
Well, you get hit with this big tax bill every year, right?
Yeah.
But you might not have the cash on hand to actually pay it.
Because all your money's tied up in those illiquid assets.
Precisely.
Oh.
It's like being rich on paper, but cash poor in reality.
Yeah, that sounds like a recipe for some serious financial stress.
Oh, absolutely.
Yeah.
And it's already happening. The article mentions that HSBC has seen a massive spike in loans against investment portfolios.
Really? Like people are having to borrow money just to pay their taxes.
Exactly. It's a 300% increase, in fact. People are scrambling to figure out how to cover these new tax liabilities.
300%. That's pretty telling.
It is. And it brings us to a really important takeaway for everyone listening. Even if you're not a multimillionaire yet, as you build your wealth, it's crucial to have a mix of liquid and illiquid assets.
So don't put all your eggs in one basket.
Exactly. Diversify. Diversify.
Yeah.
It's all about having that financial flexibility.
So you're not caught off guard when a big tax bill comes knocking.
Or any unexpected expense for that matter. But, this wealth tax isn't just impacting individuals. We're also seeing some major shifts in the market as a result.
Okay, let's talk about that. What kind of shakeups are we seeing?
Well, the article mentions London's prime property market for starters.
Oh, yeah. What's happening there?
Prices have dropped by 12% since the wealth tax was announced.
12%. That's a huge dip.
It is. And it seems like a lot of wealthy homeowners, especially those with second homes in London, are choosing to sell rather than face that annual tax bill.
So it's like they're cutting their losses.
In a way.
Yeah.
Yeah, it'll be interesting to see if this is just a temporary blip or a sign of a longer-term trend.
Yeah. Could be an opportunity for some savvy investors. Or maybe it's a warning sign. Who knows?
Time will tell.
Mhm.
And it's not just property. The financial services sector is also feeling the heat. Well, wealth management firms are booming right now. Everyone wants to figure out how to navigate this new tax landscape. So they're seeing like a 40% increase in revenue from tax planning services.
Wow. So one person's tax headache is another person's business opportunity?
Pretty much. But it's not all sunshine and roses in the industry. Smaller firms are actually struggling to keep up.
Why is that?
All the compliance costs associated with this complex new tax, it's a lot for smaller firms to handle. So while the big players are raking it in, the little guys are getting squeezed.
A classic tale of David and Goliath. The article also mentions something about people going global, like moving their money out of the UK.
Yeah, there's definitely a trend of wealthy individuals and families looking for more favorable tax environments in other countries.
Makes sense. If you've got the means, why not explore your options?
Exactly. Portugal's non-habitual resident regime is becoming quite popular. It offers some pretty sweet tax breaks for foreigners.
Interesting. So it's like a tax haven for the wealthy.
Sort of. But of course, it's not as simple as just packing your bags and moving your money. International tax laws are a whole other beast.
Yeah, I bet. It's probably best to get some expert advice before making any big moves.
Absolutely. Don't go it alone if you're thinking about moving assets abroad.
Sound advice. But hey, it's not all about dodging taxes. The article also talks about some smart planning strategies that anyone can benefit from.
Oh yeah, for sure. Even if you're not in that super wealthy category,
Yeah.
yet understanding these tactics can really help you build a more financially secure future.
Okay, so let's dive into those strategies. What are some of the key things people should be thinking about?
Well, the article covers a lot, but let's focus on three main areas: trusts and estate structures, international considerations, which we just touched on, and liquidity management.
All right, let's start with trusts. They always seem a bit mysterious to me.
Yeah, they can be a bit complicated. But one interesting thing is that residence trusts set up before April 2025 are actually exempt from this wealth tax,
Oh, really?
as long as the beneficiaries can't access the capital for at least 20 years.
So there's a bit of a loophole there.
You could say that. Yeah. It's a way to pass wealth down to future generations without getting hit with that big tax bill.
Smart planning. What about this estate freezing thing I saw mentioned? What is that all about?
So basically, it's a way to cap the taxable value of your assets.
How does that work?
You convert them into fixed income instruments.
Hmm.
So your heirs still benefit from any future appreciation, but the taxable value stays frozen at a certain point.
Ah, so you're kind of outsmarting the tax man.
In a way, yeah. It's all perfectly legal, of course.
Yeah.
Just a strategic way to manage your estate.
Okay, and we talked about international considerations, but as you said, it's a complex area. Any key things people should keep in mind?
Well, the UK has double taxation treaties with a lot of countries.
What does that mean?
It means you don't get taxed twice on the same income or assets.
Oh, that's good.
Yeah, but the details of those treaties can vary a lot. So it's important to do your research or even better, talk to an expert.
Got it. So what about liquidity management? That seems like a crucial piece of the puzzle given this whole cash flow challenge we talked about.
It is. One strategy that's becoming more popular is portfolio loans.
Portfolio loans, what are those?
Basically, you borrow against your securities at a pretty low interest rate.
And use that money to pay the wealth tax.
Exactly. That way you can keep your investments intact and hopefully benefit from continued growth.
So it's like leveraging your assets to pay the tax on those assets.
Yep, exactly. It's a way to manage your short-term obligations without sacrificing your long-term goals.
Are there any other liquidity management tools worth mentioning?
Sure, charitable remainder trusts are another option.
What are those?
Basically, you donate assets to a trust and receive income from it for a certain period of time. Then the remainder goes to the charity of your choice.
So it's a win-win. You get a tax break and support a good cause.
Exactly. Which just goes to show that tax planning isn't always about minimizing your liability. It can also be about aligning your finances with your values.
Well said. So we've talked about the mechanics of the wealth tax, the potential pitfalls, and some smart planning strategies. But I'm curious, how does the UK's approach compare to other countries that have implemented wealth taxes? It's really interesting to see how different countries have tackled this whole wealth tax thing.
Yeah, it's a global issue, for sure.
Mhm.
And there's no one-size-fits-all solution.
Definitely. So the article actually compares the UK's approach to a few other countries. What are some of the key differences?
Well, Norway, for example, has a wealth tax, but they don't include primary residences.
Oh, interesting. So in the UK, your main home is fair game.
Yep, which is a pretty big contrast.
Any idea why the UK decided to go that route?
The article suggests it's to prevent people from borrowing too heavily against their property.
Makes sense.
Yeah.
They don't want everyone racking up huge mortgages just to avoid the tax.
Right. It's about keeping the housing market somewhat balanced.
Interesting. What about other countries? How do their approaches compare?
Well, Spain has a wealth tax with much higher rates, up to 3.75% in some cases.
Wow, that's a lot higher than the UK.
It is. But they're having a big problem with tax evasion. Apparently, around 35% of people just aren't paying.
35%? That's a huge chunk of potential revenue.
Yeah, it's a big headache for the Spanish government.
Yeah.
It just goes to show how important enforcement and transparency are.
For sure. Any other interesting examples?
Switzerland, as always, is doing things a little differently. They have a decentralized system where each canton sets its own wealth tax rates.
So it's not a uniform system across the country.
Nope. Each canton has its own rules, which can lead to some inconsistencies.
This one's complicated.
Can be.
Oh.
And then there's Argentina. They tried implementing a pretty aggressive wealth tax a while back.
What happened?
It led to a lot of capital flight. People just moved their money out of the country to avoid the tax.
So it backfired.
Pretty much. It's a cautionary tale for sure.
Definitely highlights the importance of finding the right balance.
Exactly. Set the tax too high and you risk driving away wealth and investment. Too low and you're not generating enough revenue.
It's a tough balancing act for policymakers.
For sure. And we can't forget about all the economic ripple effects.
Right. It's not just about the tax itself. It's about how it impacts the wider economy.
Exactly. So let's talk about the potential winners and losers. Who stands to benefit from this new wealth tax and who might feel the pinch?
Yeah, that's the big question, isn't it?
Well, the Treasury is hoping to be a big winner. They're projecting to bring in around 15 billion pounds in annual revenue.
That's a lot of money. Hopefully that translates into better public services and social programs.
There's the idea, of course.
Uh-huh.
But the article also mentions that some groups, like the Taxpayers Alliance, are worried about a potential wealth exodus.
A wealth exodus, meaning,
People pulling their money out of the UK and moving it elsewhere. They're predicting that up to $260 billion could leave the country over the next decade.
wow, that would be a huge blow to the economy.
It would, so there's definitely a risk involved.
So potential benefits for the government, but also a potential downside for the economy. What about the average person? The ones who aren't exactly rolling in millions
Well, some economists are predicting a slight slowdown in GDP growth.
because of the tax.
Yeah. They're worried about decreased investment in entrepreneurship. But, on the other hand, we could see job creation in certain sectors, like financial services.
Because of the increased demand for tax planning and advice?
Exactly. So it's kind of a mixed bag.
Yeah, it seems like there will be winners and losers, and the overall impact will probably be felt across the board.
Pretty much.
Mm,
It just highlights how complex this whole thing is.
yeah,
And how important it is to stay informed and adaptable.
absolutely. So what's the main takeaway for our listeners? Even those who might be years away from that 10 million mark, what can they do now to prepare for the future?
I think the most important thing is to be proactive. Diversify your assets, make sure you have a good balance of liquid and illiquid holdings.
So don't put all your eggs in one basket.
Right. And don't wait until you're facing a massive tax bill to start thinking about liquidity management.
Good advice. And it's never a bad idea to talk to a financial advisor.
Oh, absolutely. They can help you develop a strategy that's right for you.
For sure. So as we wrap up here, the article ends with a pretty thought-provoking question about the future of this wealth tax.
Yeah, they present three possible scenarios. A baseline, an optimistic one, and a pessimistic one.
It really makes you think, which scenario is most likely to play out, and how will that affect our financial choices going forward?
Those are the big questions. And
That was
honestly,
the-
there's no easy answer.
Right. It's all about staying informed, weighing the risks, and making smart decisions. Well, that's all the time we have for today. Thanks for joining us on this deep dive into the UK's new wealth tax. We hope you found it informative, and as always, stay tuned for more deep dives into the topics that matter most.